Hello everybody, welcome back. This is now something on the determination of transfer prices. Until now we have always talked about what happens if the price in a contract between two enterprises which are related to each other does not correspond to market conditions. But now we have to talk a bit about how can we find out what market conditions are. And let's begin with that. How shall the market conform conditions be determined? Um, it's clear you have to compare the situation, or the requirement is the two parties involved have to do as if they were unrelated. That's, by the way, a fiction. You have to judge the situation based on a fiction, on the idea how would they behave if they were not related. Very often you have in real life a business transaction which only can be found between a subsidiary and a parent company. So the fiction, yeah, poses problems there, but at least you have a clear idea. Do as if the two parties involved were unrelated to each other. That's called the dealing at arm's length principle, which is an idea or conveys an idea of you can be friendly to each other, but you should still keep a certain friendly distance. That is where that idea of dealing at arm's length comes from. Well, you very often have enormous problems to determine, in spite of that general idea, the adequate market price, just because very often a certain product does only exist once all over the world, and it's only traded between parent and subsidiary. So there you have problems to find the comparable market price. And so you need several different methods, at least, to generate ideas what could be the adequate market price. The best and most easy idea is naturally you compare with prices which you can find in the market. But this comparable uncontrolled price method, which says just look to which prices you can find in the market for that product, that poses problems wherever you cannot find identical products and identical quantities which are traded. So if your goods are not traded in a stock exchange, where they are highly standardized and everybody agrees on the same conditions, there you have a market price. In all other cases, there will be always differences. If somebody orders a huge quantity, there will be discounts. If there is a long-term contract, suppliers, no, customers will be willing to pay a higher amount, probably, for the security or the certainty that they can make certain their supply for a longer time. All these details justify differences between your contract and the contract of somebody else, which is on the same product. Well, nevertheless, you can look to prices which you can see in the market if your product is also traded in the market. If that is the case, well, the second method would be the resale price method. Then you have the cost plus method, also that can be sort of, and rather modern inventions, the transactional net margin method, TNMM, or even the profit split method. All these methods are regarded as standard methods, and nowadays one would say a careful and responsible manager would form the ideas which price to demand or which price to pay on the grounds of one of these methods. And he or she or it would not also just follow one of the methods, but also have some business motives in choosing the best one, or would have reasons why the method which they have chosen is regarded by them as the best of the methods available, because a careful and responsible manager would try to maximize the profit. So just to say, I do a cost plus calculation, and this is something which can be found in the world, so this is an economically viable behavior, so that is okay for me. That would be negligent. It would not be careful enough, because a good manager would always think about if another strategy and another price calculation method would not end up with a higher profit, and therefore be a more careful fulfillment of your duties to your shareholders. And so you would have to first follow a method, and also to be able to give reasons why you choose the method which you choose. The problem with all the methods is that the necessary data which you need is often not easily available. For example, you need information on comparable enterprises and their behavior, and although many data are published, everybody always tries to hide the details. So it's not easy to get the information. You know that in real life there are some enterprises which have data banks, databases, sorry, where they get the information and can supply you with necessary data, but you probably never have somebody else in exactly the same situation. So you have always adjust the data to your situation, and take into account that a difference in the situation will also cause a difference in the pricing behavior. So the main points with the comparable uncontrolled pricing method is that you have two alternatives. First, the internal comparable method. That means for which amount do you yourself sell your product or your services to others? If you do that, then that gives a clear indicator what you charge to unrelated persons. And then naturally one would demand that to your related parties, so the companies in your own group, you show the same behavior, but naturally again adjusted by those adjustments which are economically reasonable to account for the differences in the situation. So if your sister company orders 1 million items per year, and outside customers only order 100,000, then naturally this difference in the quantity and in the consumer or customer power naturally makes it necessary to have different pricing agreements. So you can't exactly compare. Nevertheless, it is a possibility first to look to what do you yourself pay to others or demand from others. If that's not possible, or in addition to that, you can also opt for the external comparable price method. That is, if you have two outsiders and you see that they trade the product, what do they charge? So not not you yourself, but others. You can observe that B sells your product to C for a price of 100. Then you see, okay, that seems to be the market price between others. So why is 100 then not also my market price? You would need reasons for that. The problem is the goods traded are not fully comparable. Usually the quantities differ. The conditions for delivery, all that justifies or even necessitates deviations. The problem also is the more people you watch, the more different prices you get. because that's the problem with market prices. They are not always identical. It might even be a strategy to deviate from the behavior of others. For example, if you are the Aldi markets, it would probably be a very wrong idea to say, when it comes to pricing behavior, to look what other traders demand for their products, because I do not know if you know these Aldi markets or Lidl or so, they are discounters, so their strategy is to sell for a far lower price than their competitors. So in case that you follow such a business strategy, it would be really contradictory to say, we can observe that our product is traded for a price of 100 in the market, so 100 is the price which we should take. With such a business strategy, you should probably say, we can see that all the others sell for 100, so our price would, under unrelated parties, be at highest 80 or 70, because we always set our prices far lower than the competitors. That is where we live from. That's our strategy. So you would have to take that into account and have to show that this is indeed true. So the comparable uncontrolled pricing method can only give you indicators for which price could be justified. But there is not the one and only correct market price, only a range of potential possible outcomes. That seems to be the problem. If you go to that resale price method, ladies and gentlemen, you remember probably the basic idea. If not, let me remind you of that. If the price which a trader gets from a non-related customer is known, so that's indeed a market price. You have a customer buying, let's say, fashion, and you can sell the final, let's say, designer shirt for 100. So there you have a fixed given amount of money. And now you could calculate backwards and say, if traders usually, when they sell shirts, add to their own purchase price a certain profit margin, always the same percentage, then we can calculate backwards and say, what would such a trader, if he or she knows I can sell this product to customers for 100, what would that trader be willing to pay to the producer of such a shirt? So that is how you can get an estimate for the price between producer and trader if both are related parties. So to illustrate that by an example, if you know you can sell, the trader can sell the finished product for 1,000 to an outsider, and the usual profit margin, no, sorry, I was distracted. If the trader usually says, I pay 1,000, I add 300% profit margin, so my final price would be 4,000, then you know for that sector of economy, for that trade, 300% markup are usual, or 3/4 of the final price goes to the trader and 1/4 is passed on to the producer. Then you can use that information to calculate backwards. For example, if you can sell products for 12,000 to a final customer, an outsider, then you would say, okay, according to what I can observe in this sector, 3/4 go to the trader, 1/4 goes to the producer or the wholesaler or so. So that is the idea of the resale price method. It's a nice idea, but when you bring it into contact with reality, then you see not every trader has the same markup or profit span. Because some chose to have a smaller markup and So to be able to offer for lower prices and to attract customers. So you only get a range of profit spans. The second thing is most people who are in trade make a huge secret of their profit span, so it's difficult to find out. It's probably not a very good idea to drop in at a competitor's shop, ring the bell, or try to start a conversation. Could you please tell me how many percent is your markup on the purchase price? Um, you will get many answers, but let me guess, the true one will not be contained in all these answers. That's rather more a secret. So also there, you can only do guesswork. You can only find a range. You need probably anonymized statistics or so. The problem is the fiscal administration has these data. You don't have them. So that poses some problems. You get no precise results. There's also the very traditional method of cost calculation plus markup that is equals then the price. So you take the cost, add profit margin, and this is your price. Now the question is, which cost do you have to take? For which purpose? What is the adequate percentage for a profit which you add up? That's also rather arbitrary. Well, if you want to find out in your sector of economy what all your competitors have as profit span, congratulations, you will not get that information voluntarily. So you need statistics, which you probably don't have access to. You need to find that out from published financial reports if you can. Um, that's rather an expert job. And you will get a wide range because naturally that will differ. Okay, and you also have learned probably somewhere in business administration that calculating your price based on cost plus a markup for the profit is not a very convincing approach if the people in the market would even be willing to pay a higher price. So by that you can only justify a minimum price, but not show that this is the market price. If you have the opportunity to get away with a higher price, you will take it. So cost plus is not always compatible with the interest of a careful manager to maximize the profit. So very often cost plus method is only regarded as adequate where you have so many competitors that if you claim more than that minimum price plus the minimum profit which you need to survive in your sector, then your customer goes away and gives orders to your competitors. If that is not the case, if you have a rather strong position, if you have some intellectual property or some knowledge or abilities which others cannot offer, then usually cost plus is not the method to which you are forced to adhere. You will probably take more and will be able to um, yeah, to get along with higher price demands. The transactional net margin method is an additional method which says, okay, I show that my prices are conform to market because certain indicators for the results of the transaction are in line with what we can find in the market. So let's say the operating margin, that is the profit in relation to the price, that percentage is market conform, or you have operating profit in relation to full costs, also market conform, or the profit in related to the assets which you use. There might be several indicators which you might regard as adequate, and you try to show that what you did is in line with what is usual in the market. One of the ideas might even be you show that the profit from the whole transaction is split up between the two parties involved in a way which is conform to market behavior. That can be a reasonable approach in those cases where both partners have some elements which make them relatively strong in negotiations, and where one could argue if two partners with these abilities would work together in a partnership, then they would probably split up the profit from the partnership according to that percentage, which here has been chosen to attribute parts of the profit to the one partner and part of the profit to the other partner. So to make it plausible that the way how these people negotiated with each other ended in everybody gets that part of the common made profit, which probably outsiders also and unrelated parties would also have given to each other. Yeah, the problem with all these methods is, ladies and gentlemen, as you have seen here, you never end up with a precise result for the market conform price. So you always end up with a range, probably different. If you have several methods and they all indicate the same range, then you can be already a bit more confident. But the problem is you never get the one and only price. You get only a range of plausible results. And this causes a huge amount of uncertainty wherever you have to do with all that. You need to find the result, but there is not the one and only result, so you can only guess around. It's rather a fiction that you can find the market price. The last economist who really believed in the existence of a true value, not even a true price, that was Karl Marx. Since then, economic theory has passed on, and nowadays we think, okay, prices in the market are entirely dependent from supply and demand, from the ideas and preferences of the people involved. So it's all very subjective and arbitrary process. There are certain limits, an upper price limit and a lower price limit, but also that already depends on the personal circumstances of the people involved and the alternatives and so. So there is no real market price, and that makes it clear why it is so heavily difficult to find it. The only thing which you can realistically prove, where you can use that whole transfer pricing rule system for, is to make sure that the conditions which are agreed upon between related parties are not entirely text-driven, but follow a business administration logic. That is the only thing which you probably can make certain in real life. The rest is just arbitrary. So more than to force the parties involved to show that their behavior is compliant with what independent business might also do, that they rely on business logic and not on the tax department. That is probably the maximum which you can achieve. So the whole affair is probably only giving you a very rough orientation, which ends up with a very vague thing. Now, when you have a whole range of possible outcomes and have to decide for one price within that range, then necessarily your final decision will be rather arbitrary. And now when the fiscal authorities also have the right to form an opinion, their decision will probably be a different one, and it will also be arbitrary. They choose the solution which fits them most, which they like most. You chose the solution which you, for different reasons, liked most. And if there is even a second fiscal authority involved, which is always the case in cross-border cases, then the second fiscal authority will also choose or develop a view on what would be the best market price, and that view will differ from the other two views, and that will also be arbitrary. So the whole thing is not really an example for what legal certainty should be and how tax laws should be written. You can illustrate what we really are doing here if you look through all the details. You can sum up what law tries here with a very old joke, in which one can adapt to transfer pricing. Science is defined as the quest for a dark cat in a very dark room at the darkest moment of midnight. Philosophy is defined as the quest for a dark cat in a very dark room at the darkest moment of midnight, if that cat does in reality not exist. And now transfer pricing is the quest for a dark cat in a very dark room at the darkest moment of midnight, if that cat does not exist at all, but the searcher has to sign a solemn statement that he has found it. And that is exactly the situation when it comes to transfer pricing, and that is why it's always so vague and so different, and always a question in the final end, a question of what all the people involved agree upon. Which fiction do we want to decide for? Do we want to decide for, okay, we are all willing to believe that 100 is the adequate market price in this situation, or let's agree on 105. So this is, when it comes to final decisions, more or less always a question of the Basari principle. Let's negotiate. Who blinks has lost. So not a perfect example, not a good solution which shows legal certainty or something else. It's the complete opposite. Here we have an element in the international tax regimes, tax rules, which is completely arbitrary, although people hush it up very convincingly. Well, there seems to be no better solution, but in principle we should make clear to ourselves, okay, we are looking in the dark for something which our economists have said since 100 years and more, it does not really exist. So not a good idea. Well, somebody should look for a different concept. Unfortunately, it will take some 100 years, if you find it, until everybody in the world accepts it. Now, that fact that you can only decide arbitrarily within a whole range of possible solutions, and that makes things complicated again, because now even the most principal idea or wish of the fiscal administrations is, we do not want you to set your transfer prices in an arbitrary way. We want to have rationality behind that. And so you can only decide arbitrarily within the range, and the fiscal administration says, show me that it's not arbitrary. And what do you do in such a situation? You force the other person to have arguments, reasonable, convincing arguments for the selection for which they opted. So more and more, the law and the administrations pile up requirements for documentation of why you did what you did, so that one can at least have a debate about what happened. And so you get more and more requirements for documentation. So that's the problem. To sum up what we said just now, or what I said, and I hope you believe it, on transfer pricing, and the basic problems is, when you have to decide for an outcome within the range, it will either be arbitrary, or it will get very complicated, or most likely it will get both arbitrary and complicated, because you have that conflicting thing. You can only decide arbitrary, but they want you that your decision to show that your decision was not arbitrary, and so this is something complicated. To follow contradictory aims usually is nothing which is going to make the people involved very happy. Well, every psychologist can tell you that, and we can show it here in transfer pricing. So whenever you have a job in transfer pricing, having to find out the market price, you have a safe job position. That problem will never get really solved until somebody has the courage to put the whole thing aside and decide for a completely different concept. For example, for a formula apportionment of group profits to the states involved. This is undercover a bit an idea which is already built in a European Union draft for a directive on consolidated company taxation, which will probably not be agreed upon during our lifetimes. But that shows that at least there are in first small steps at the legislation level that people evidently begin to understand what they are doing here with all that transfer pricing stuff. Yeah, so more and more documentation is demanded. You need to show your reasons for your market price. And the documentation duties which are imposed by the states involved might be contradictory. One tries to avoid that and to harmonize the necessary transfer pricing documentation on a worldwide scale. The OECD has done some good stuff there so that at least you can say, I do not need to documentate completely different things for completely different states. But naturally, the legal basis for the documentation duties will be different in every state, and in detail there might be differences. In Germany, the best recommendation to get a rough understanding of the documentation duties is see to paragraph 90 AO. There is also something called the Gewinnabgrenzungsaufzeichnungsverordnung. And there is even some fines or drastic consequences of other kind which the fiscal administration can draw if your documentation of your transfer prices is not sufficient. You find them in paragraph 162 AO, especially if your documentation isn't convincing or not sufficient. They get the permission to estimate the adequate market profit higher than the profit which you declared, and that's very, very inconvenient because it always has drastic consequences. Furthermore, one tries more and more to give legal standards how you have to choose within the range of possible results. Now, the problem is the range of possible results naturally depends on statistics and the data which you have available. So if you overlooked some competitors, or if you have some more competitors taken into consideration than others, you get a completely different range of comparable prices, probably. So also that is again something arbitrary, but at least you get more and more precise rules how to choose within the bandwidth of alternative results. For example, Germany has established in subparagraph 3 of paragraph 1 ASDG a very, very long description how the adequate transfer price has to be chosen and has regulated special cases. And the OECD has issued more and more reports on what should be done, how by which methods and which ideas an adequate transfer price should be found within a group, for example, for intellectual property, and which circumstances should be taken into account and how reasonable persons would behave. That's interesting because sometimes the persons who really act in the market would be surprised when they hear how they should act according to the ideas of the fiscal administration. But that seems to be always driven by the motive we want to make things as clear as we can, and yeah, so that at least all the fiscal administrations can say we want to have within that range of many possible results, we want at least to have a route to one more precise result where we all can agree upon, although everybody must in the end know what you are looking for there is just a fiction. From the perspective of theory, what you are looking there for is sheer rubbish. It's the dark cat in the very dark room at midnight, which does not exist. There is not the market price. But in the end, you have to declare it and you have to sign your tax declaration. And if it comes out that it's not the market price what you declared, then one could even debate about tax fraud. So this is rather a nice construction which we have here. So naturally, as you are looking for something which does not really exist and want to be precise, you have to have more and more guidelines, which are more and more precise because naturally you want to narrow things down. If you look for the non-existing solution, you need a very good travel guide. Otherwise, everybody ends up somewhere else, and that is probably the reason why we get or have got during the last decades more and more comprehensive rules on the OECD level, so that all the important fiscal administrations of the world agreed on the same or similar details how to determine the transfer price in certain specific circumstances. Okay, this should be sufficient for this topic. Naturally, after we have seen now that transfer pricing is very vague indeed, and that you have many possible outcomes, then naturally another topic which automatically is combined with that is how do we resolve disputes if, for example, two fiscal administrations involved in a matter come to different results, and they both want to insist in their solution, so that in the end the taxpayer is taxed on contradictory data. And this is naturally something for the next time, for the next subchapter of this lecture. Thank you very much for watching. Recover well from what you heard just now, and drop in again as soon as you can. Thanks. Try to recommend the channel to others. And that was enough for today.